So should we invest money or be saving money instead in these challenging times of inflation and high interest rates? Hi guys, welcome back to another episode of the Young Money Hackers podcast, here with HD and Charlie. And today we're going to be discussing the argument between saving money versus investing money. And also give you guys some real life examples comparing some of the current interest rate returns on savings accounts versus the returns on a property investment. So I'll start off with a cheesy quote from Warren Buffett, who is worth $117 billion. He says, "Do not save what is left after spending, but spend what is left after saving," right? So obviously that just indicates that it is extremely important to be saving regardless of what is going on. You know, saving is like the oxygen to your money plan, but investing, that's like the fuel that accelerates your wealth over time. So my opinion on that is that it's always good to be investing, right? So this comparison gets really interesting because some of the banks now are offering 5% on savings accounts at the moment. So naturally, people are enticed to build their money in their savings account, which is really good. But as a strategy to build wealth, to me, is a questionable strategy.
Yeah, that's right. If you look at the business model of banks in general, right? If you look at the business model of banks, is they receive your money, right? They pay for giving you, for receiving your money, which is if you bank $100 and deposit it into your bank thanks you and gives you money at 5%. That's what that savings account that you're talking about was. And what they do is they lend that money out to a developer, right? Or some investor who will pay them more than that 5% in interest rate. So they will pay, I don't know, if they're just going to buy a house with it, they're going to pay 5.5%. So they make $5.50 and they pay you $5. They make 50% gain on money that they don't own. It's just your money, right? So that's the business of money in the bank. Now, think about the investor. Is the investor borrowing money at 5.5% because it's fun? No, he's borrowed $100 from the bank for 5.5% because there's an investment out there for him that he's generating something above 5.5%. And the banks are not going to lend you $100 at 5.5% if they don't think that your investment is going to make more than 5.5%, or you can afford to pay that 5.5%. That's the whole lending criteria, right? That's the whole point about that's the whole point of the assessment. Do you have enough money? Do you have enough serviceability? You know, all that question around how much can you borrow. That's all that they are assessing, and they want to profit off of this money. Now, here's the thing: out of this, you got the investor who makes more money than 5.5%. You got the bank who makes 5.5%, and you got the bank who pays 5%, and then you got you who receives a deposit, who receives an interest on your deposit, right? That you're basically at the very bottom of the food chain when it comes to the flow of money. Banks are not at the top. Banks are actually in the middle. The investor is at the top. The bank is waiting. The income, the cash generation of bank as a business model comes from investors. So that the money that they pick up as deposits from the clients, or not really, well, I guess they're clients, but money they pick up as from the depositors can be rented out for a higher fee than the fee they have to pay you for giving them the asset in the first place, which is cash. So that's the thing. Right. If you're thinking that in this market, interest rates are high, and that's why I'm just going to put money in, that's quite lazy. If you think about it, there are investments still out there that are and the reason why interest rates have become so high is because the government has realized, like the high power, the lord of money, if you like, have assessed out of inflation and everything that's happened in the recent years and what they think is going to happen in the future, that there are a lot of investments out there that are doing super duper well. Like there's a lot of investment out there doing really well. There's a lot of equity that's been made, and that's why investors are making too much money. Let's bring some more of the money back into the pockets of the banks and then the depositors, right? So that there's a good equilibrium and balance of things as the world and as the money changes. That's why we're seeing higher interest rates coming in, basically. So in this line of thinking, and no matter what scenario I think you'll find yourself in, the investors will be the ones that generate the most money, the biggest gap, if you like. So you may argue, however, that your $100 making 5% is a bigger gap than the investor making 8% and having to pay 5.5%, therefore making 2.5% on their gains. That's true. But in that chain of thinking, you're kind of the laziest person, right? The most active and the hardest working person is the investor, because that guy is out there trying to find the investment that returns the best. And that's kind of the fun, because when you can lock in those high returning assets and investment, and then your interest rate goes back down, right? Then guess who's getting squeezed? It's you guys, the depositors. They're remember back when COVID was around, what was the interest on deposit? It was like 0.5% or something, completely some completely useless figure, right? So you're there, basically. You're going to be there. You're going to be squeezed down there. Whereas when that happens, the investors that are making the tough decisions now, finding the good deals, right, finding the right properties to invest in, man, they are laughing. That's the thing.
Exactly. So you're saying that if the banks are offering 4.5% to 5% on their savings, that's an indicator that investors are getting more than that.
Absolutely.
Yes.
Absolutely. And another thing to take note is this as well. I feel more sorry for the people who bought property when interest rates were low. They were over leveraged, and like we live in Australia where we can't lock in interest rates for 30 years, right? Because that's how things are done in the United States, but not here in Australia. So they are now in a position where the new cash flow, the outlay has gone up. Thankfully, the other end of it has also gone up. Like your rentals have gone up and things like that. But your owner occupiers, they're really struggling. So that's why investors are still always kind of protected, if you know what I mean, because the rents are going to go up on the other end, right? And obviously you need to find properties where during a recession you'll be reasonably well protected, because you're going to have rentals that are going to increase on the other end as well, right? So, but the people who bought at paper thin interest rates are the ones that are in trouble right now. People who can qualify for a loan right now and get into an investment property right now are the ones that are going to be laughing in the near to medium to long term future, where the average interest rate is going to fall below, or the interest rate at that time is going to fall below what they have committed on right now. And they got those high returns, they got those high rental cash flow coming in, and between now and then there's still capital gains, which we're going to talk about, right? So, but where are we sitting right now? I mean,
Hold up, young money hackers, we got some exciting news to share with you, because it's all well and good to hear what's going on, but we'd hate to see our young money hackers only listen and take no action. So we've been working on some game-changing tools that we wish we had before buying our first investment property.
Exactly right, man. And it all starts with numbers. Property investing can feel like an extremely overwhelming process, because it's the biggest financial decision that most people will ever make. So we have developed a property investing calculator that will make this whole process effortlessly. And seriously, man, I'm actually so blown away at how easy they are to use. All you need to do is put in your numbers and the info will tell you if that property is worth it or not. I'm actually so proud of them. Genuinely can't wait for our young money hackers to get their hands on this experience. But that's not all that's new here. We also have a mentorship experience.
And that's right, we want to share with you all the juicy details to see you through to that end goal where you're profitable on your property investments.
We also come across so many investment opportunities given the property space we play in, so it'd be rude not to share those with our young money hackers. So if you'd like to get your hands on some of the deals we are talking about on the podcast, we are offering acquisition services where we and our team will hunt down properties for you to push the button and get started to add to your property portfolio.
And what a dream it is, Charlie. And there's more. We're going to hook you up with top-notch property finance and insurance so we can all sleep at night.
But HD, what if I don't have the money to invest in any of these services right away? Is there anything for free?
Well, actually, we can help you with your finance and insurances for free. Plus, there are a ton of free resources we have for you, like some of the investment calculators, books, and tutorials available on our website.
Well, you heard him, everyone. So head over to our website, youngmoneyhackers.com, or simply click the link in the description. Check out our investment calculators, learn more about our mentorship program, and explore our acquisition services. At the very least, don't miss out on the free resources we've put together to help you guys get started. Now back to the podcast. Currently, we're sitting slightly above that. So we're at 6.87% interest rates, so the cash rate is, I believe, 4.1% today. Now, the average, the 30-year average for the cash rate is 3.84%. So we're slightly above where we should be, but not by as much as what I think people think there. That a lot of people, I think, are under the impression that interest rates and the cash rate have just gone through the roof and this is absurd, when really they're only slightly above where they should be. And as you were just saying, HD, like for the people that realize that and can get into something now, this could be an amazing point of entry, rather than leaving your money in the bank and hoping for a 5% return over maybe 6 months for them to then drop that interest rate to whatever it is, 1%. And as you said, you get squeezed and like, it's just not a nice outcome. If hypothetically you were to get into a property now with a high interest rate and high rents that will make up for that high interest rate, over time, what's going to happen? Interest rates aren't going to continue to rise at the rate they are now. They will eventually this inflation curve will start to reduce. Interest rates will come down. Values will go up. It'll give you guys the opportunity to refinance, and you're going to be the ones that like ahead of the 8 ball, like massively. Right.
And another thing people fail to realize is leverage. So we talked about it in another episode of podcast as well, but when you invest into property, if something is returning 6%, 7% on a gross yield, on a gross price of a particular asset, that doesn't mean you're making 6% on the dollar. You basically leverage that on a deposit with a bank finance. Therefore, your cash on cash return is much, much, much higher than that. So if you're comparing 5% on every single dollar you own, right, versus a property investment that's going to be inflated to double-digit returns, right? You really haven't thought about property. You really haven't. Property doesn't work that way. Property is leverage. Yeah. Property has potential to have much better cash-on-cash return. And I think that we talked about this back in the what's better investing into stocks or real estate. And so that's, I think, we did discuss that. So that's where you're going to find a lot more information on it. So make sure you guys check out that podcast as well. Now, today, I also wanted to share a little chart as well. We're looking at the Australian cash rate on the right-hand side, and on the left-hand side, we're looking at the Australian mean dwelling price over the last 10 years, right? Since 2012 to where we are right now. And if I could just explain what I'm observing here is that the cash rate is being corrected by human beings that work in government at the top as a reactive measure to what they're seeing in the property market. I mean, over the entire economy in general, of course, but the property market is a big part of the economy. It has implications on inflation, implications on people's disposable income, and obviously people's livelihoods as well. So what I can see just from the last 10 years of data is that we've got this one point of reference, which is that dip in 2018. So in 2018, the dip has begun at the beginning of the year, but the cash rate only starts to reduce after a little bit, after about a bit later in the cycle between 2018 to 2020. And that's because the government is reacting, the prices are dropping. So we need to make sure that the money is easier to borrow for people to come in and make more purchase and create more demand out in the market, which is true. Interest rates have since then started to increase. So yes, it is the right thing. If you have access to low interest rates like 0 to 1% cash rate at the government level, then I think it is in everyone's best interest to start buying like crazy, right? And make sure you buy investments and that have really high returns. You still got to focus on that, because if you think about it, like the repayments have gone up. I'm talking about investors here. I'm not talking about owner occupiers. Owner occupiers, I think you guys are pretty much stuffed if you don't have the right cash flow for it. But as long as you're an investor and say your rentals have gone up, which is great, but and also rentals can go up at a bit of a lagging measure as well. But what we did see go up is since 2020 to 2022, the peak, there has been some 80% increase on the median price. We're looking at an index rate of about 650 to about 950 there. So that's pretty crazy gain that you're seeing there. So your capital has actually done really well on the other end as well. The prices have been falling since the beginning of this year. Obviously, it's a small correction. It's about a 10% correction, I would say. And as this correction is happening, we do not see any sign of the interest rates falling just yet. I'm not going to sit here and make a prediction on when the interest rates are going to decrease, right? And how much it's going to decrease by. But we can see how the pattern has been in the past is that governments keep an eye on property, and when they see that property prices go down, they taper off the increase in interest rates. I think it may well still go up, but that shouldn't scare you anyway, because you're still buying at a slight dip. You're not buying at the peak or top, right? And you're also not buying at the peak or top of, even if you probably want to buy at the peak or top of the interest rates, but at least you're near to the top. So I think right now is still a fantastic buying opportunity. And at the same time, don't just look at interest rates when you buy a property. Look at the actual property you're buying.
Yes, I totally agree with that. It's like, it's something to just get into a property. A lot of investors will get into a property and they'll get 3% yield. They're not focused on the performance. And then as the economy changes, like the interest rates go up and they're having to jack the rents up to the point where, the tenants are not happy and they want to move out. So focusing on the actual asset itself is what is like the key here.
And with each deal, you're going to be able to run the math before you purchase and say, hey, this is going to get me X amount of dollars every year into my pocket, not out of my pocket. If we look at its historical data, we expect this property to go up by X% this year. That on the purchase or the acquisition price is going to make me X amount of dollars richer in terms of equity as well. Do the math first. Yeah. Now, as young people, the young money hackers, we're all about the young people money out there. Get into an investment where you identify this, where you know how much you're going to make, where you know how much, as in terms of cash flow, and how much equity is going to come in. Get into an affordable investment. Don't get into don't stretch yourself out. We were talking about how people go for that Australian dream, 4-bedroom house where you can raise a dog and a cat and a girlfriend and everybody else in the house. Great. But the problem is you end up realizing that you don't have enough money to buy at a location that you want to live in. So then you compromise. So you get a bit further away from where you need to be, right? Whether a city center or or nearer to the place of your work, which is likely going to be at a hotspot, right? So you're getting away from these hotspots where the property prices are higher so that you can pay less for your property. So you're getting away from your dream. But then also it's not actually quite at the right location for an opportunistic investment. So it's actually not a good investment either. So you're not getting the dream, you're not getting the investment, you're just sort of stuck somewhere in between, and you're basically maxed out at the same time.
Yeah.
And you cannot embark on any other further investments either. So that first property is so important. So here at Young Money Hackers, we help you out with all that kind of stuff.
Yeah.
What you need to do is subscribe and listen to what we say. If you're interested, reach out to us. Thanks for tuning.
Yes, you have to subscribe. That's your first step. Subscribe and just stay tuned, guys.
Thanks for tuning in today. I really appreciate it. Send us a message. Peace out.
Cheers, guys.